I'm joined here today by Olivia Thoral, AXA Real Estate, Dan Fasulo at Real Capital Analytics, and Gino Sabatini at WP Carey. Gentlemen, thank you so much for joining me today. We're looking at exit strategies, and particularly in the US and the market. I think we're definitely seeing a market that is almost full to rebound and has really recovered. Yet a lot of investors are clamouring for yield, clamouring for deals. Gino, I want to open up the questions to you. What are you seeing on the ground in terms of opportunities and competition in terms of pricing?
The U.S. is very competitive, there's no doubt about it. There's a flood of capital both on the retail and the institutional side, and people are searching for yield. It's a low yield environment, and people need cash to live on. You can't spend IRR on a daily basis. So in a search for that yield, they're bidding up the prices of assets, pushing cap rates down. And what's surprising is that certain markets, which historically have commanded a premium, a secondary market in Iowa, for instance, now trades at a very similar cap rate or yield to a primary market. So we've actually, especially on the shorter term deals, decided to focus on some of the more primary markets because we think there's probably less risk associated with those assets for a similar yield.
And Olivia, I know obviously you're building AXA's portfolio, obviously, in the US. What are you seeing on the ground?
Yeah, as you know, AXA has been a very large asset manager in Europe for nearly 15 years, and we have started in the US over 4 years ago. So we don't have a huge portfolio of real estate in the US today, so we are growing that portfolio carefully, smartly, again, both taking into account our client objectives, and they want to get exposure, and it's rather a long-term exposure for most of them than just an opportunistic play. Also, we need also to take into account the state of the market, and as we said before, this is a very competitive market. Core prime properties are probably overpriced, so we are looking for ways to grow the value over time. And one of the strategies we are implementing is on the office investment, is to look for leasing risk, for repositioning risk, whereby even if you are in a prime location, there are a little bit less competition. You can achieve also a growth of the NOI, which over time will give protection against rising interest rates.
Dan, talk us through some of the headline figures that you've seen in terms of the US market and capital trends. What was transaction volume growth when you're looking back at 2013?
We did about $350 billion with transactions last year. That's all the property sectors. It was up about 20% year over year. There's some differences based on which sector you were in, but everything's moving in the right direction. There has been a massive shift or massive flows from core primary to secondary markets and secondary property types. And it kind of started in 2011. Last year it really sped up. And the market capital is not really discriminating market by market anymore. It's really, wherever there's some nice yield to be achieved, there's capital there today. And it's not just the equity side, it's the debt side as well, which is probably the missing ingredient to make all these secondary markets move again.
Olivia, are you actually expanding your search in terms of where you're searching for deals, given what's happening with the ultra-core markets and pricing there?
We are targeting more or less the 10 largest US markets. We have a focus on those gateway cities which are resource constraints, because that's a protection of long-term values. We are also looking at a build-to-suit industrial strategy, again, because we believe it's a way to get invested in solid income-producing properties, and with the right selection of the partners in terms of delivering the construction and the location. So a little bit contrary to WP Carey, we are not just focused on income or primarily focused in income. We are also looking at the capital values, not just as an exit, but throughout the life of the property, because an important part of our capital might have liquidity objectives sooner rather than later. So we need to be able to have sustained capital values throughout the life of an investment.
That makes a ton of sense, and actually that's what creates opportunities for buyers and sellers. We have different objectives for our capital. He may need to get out of a property because his hold period is shorter and his investor demand
Exactly.
is different. And on the other hand, you know, we have investors who are looking for longer hold periods.
With that focus on perhaps some of the perhaps more core primary markets, what are your expectations in terms of then like vacancy and rent growth? What are the underlying drivers of kind of that NOI growth?
We want to be convinced that there is a real ability to grow income. So it may be that we look at a property which is undermanaged and therefore which has a much higher vacancy rate than the average on the market, or which is significantly underleased. But we are rather looking for vacancy and working on active asset management to release that property, to lease up that property, rather than
Rental
betting
growth,
on
yeah.
Rental growth, because we all know that it's highly cyclical.
Are people really underwriting the rental growth as they look forward for the prime markets?
What choice do you have? I mean, in a place like Manhattan, if you're not underwriting growth, you're not winning the deal. I mean, we're already back to that in your top 5 or 10 markets, across the board when it comes to property sectors. And, I mean, it's a decent bet in certain supply-constrained environments where, vacancy levels have gotten back to that kind of historical point where rents start to spike. We're close in a couple of markets. But nationwide, I mean, that's when I get nervous, is when you're underwriting, 3 to 5% growth in Chicago, or Houston.
We really don't factor in rental growth at all in our back end residual value assumption. We factor in the rents that are built into the lease, and that's it. And we lose a ton of deals. I couldn't tell you how many we see every week, probably 100. And we do maybe 35 a year. As Dan said, the only way to win, especially core MSA deals, is to assume a larger back-end residual. And you can either do that through aggressive rent growth assumptions or through a big sale price down the road. It comes out to the same bet that you need to make.
And with interest rates obviously expected to increase, are we going to see cap rate expansion in the future? What does this mean for kind of some of the pricing of the deals that's out there?
I think it varies by property sector. Multifamily makes me a little nervous because rents have basically come back to an all-time high. Expenses are going up, taxes are through the roof. And so if debt costs do rise for multifamily, you're not going to be able to squeeze out as much income to kind of negate higher debt costs. But for retail industrial properties that need a lease-up type situation, rents are still 15-20% below kind of former peaks. You have some room to run on the NOI side if rates do go up. Given the wall of capital we're tracking, both on the equity and debt side, there is a scenario where rates come up a little bit and cap rates still fall, if you believe it, given kind of the historical spreads we're seeing out there.
And Olivia, as you kind of look to rising interest rates, what are you expecting to see in the market in terms of the kind of your underwriting?
Well, when we underwrite, we underwrite over time an increase of cap rate because we want to be on the safe side. We are losing deals for that reason as well, but I think Dan is right. In some cases, there is so much capital that it put into question a lot of the traditional views on markets. However, we can't see how cap rates could not increase at some point. The question is when, by how much, and there are various scenarios. So that's where you need to build a solid underwriting to assess the level of risk you can take depending on your client objectives, depending on the specifics of an individual property. And there is a price point beyond which you don't go, and well, either it works or you lose.
There's a lot of other wild cards too. I mean, I heard down in DC, the 1031 exchange is in play here in America, which makes me nervous. I'm sure it makes everyone nervous.
What is making you nervous as you look out at the market with pricing today?
Well, given our business, how we're a long-term holder, and we actually set our debt for a very long term at the inception of the lease as well, short-term rises in interest rates don't affect the assets that we already have on our balance sheet. Now, if this scenario that Dan laid out with rising interest rates and falling cap rates would actually occur, we would become a seller very quickly. That would be kind of a sure sign that the market is overheated. My guess would be that interest rates will rise, as I think everyone is expecting, and cap rates will follow at some point. And you know, the question is, how quickly will they move up in lockstep?
So just perhaps with a crystal ball in hand, would you be able to predict, you know, kind of where transaction volume is going to be 2014 and maybe looking out over the next couple of years?
Yeah, Q1 was strong. It was up year over year, the largest quarter we've had since 2007 for the first quarter. And the debt markets continue to perk up, as we talked about. CMBS is back in a big way. Unless something blows up, I think we're going to see continued momentum.
I think the momentum will continue. As the equity is there and continues to come in. The debt markets remain good. Different people have different reasons they need to sell at all times. So I think all the conditions are there for a continued strong market.